All investments, including stocks and mutual funds, are subject to market risks. The figures here are indicative and provided to explain underlying concepts. Please do thorough research before making investment decisions. Welcome to a tale of two paths, gardening your wealth with SIPs or chasing treasure with stocks. Which journey will you take? I'm M. Kannan, an author and consultant with years of experience helping investors navigate complex markets. Will you choose the steady ship or the fast-paced speedboat? Let's explore. Let's first examine the performance of stocks versus SIPs in mutual funds. Starting with stocks, where investors often search for opportunities. Only around 15% of stocks outperform the market, and a mere 1.1% of investors get consistent profits. Individual stocks can be quite volatile, with risk levels ranging from 30% to over 60%, especially for tech and growth stocks. Stocks can yield extreme returns from -100% to over 20% annually. The Nifty 50 index has averaged around 14% over the last decade. Now, let's look at SIPs, in mutual funds, a steady and reliable investment option. With SIPs, around 80% of long-term investments give positive returns after 5 years. SIPs are less volatile, with large-cap mutual funds showing only 15 to 20% risk annually. SIPs typically provide consistent returns, averaging 12 to 15% over a 10-year period. Stocks have a higher risk and more volatility. Only about 15% of stocks consistently outperform the market. On the other hand, SIPs in mutual funds offer a more stable option, with about 70% of SIPs delivering positive returns over the long term. Stocks may offer big rewards but come with high risks, while SIPs provide steady, reliable returns with less emotional stress. Let's talk about the commitment needed for stocks versus SIPs. Stocks can be stressful, and many first-time investors drop out in the first year. Stocks can lead to anxiety with market fluctuations, with only few of new investors seeing consistent positive returns. Research and monitoring take a lot of time, sometimes hours every week. To succeed in stocks, you need strong market knowledge and company analysis skills. SIPs, on the other hand, are less stressful, giving you peace of mind. SIPs reduce emotional stress thanks to professional management and diversification. SIPs are automated, requiring just a few hours a year. You don't need deep market expertise, just basic knowledge to get started. Stocks demand more time, expertise, and emotional resilience. Investors need to actively research and manage their portfolios. In contrast, SIPs offer a more hands-off approach with professional management, requiring minimal time and less emotional stress, making them easier for long-term investors. Let's dive into the risks and how they're managed. Stocks are like a speedboat, quick but often risky. Stocks carry a higher risk of market manipulation, with many cases reported each year. You have to manage corporate actions like mergers or splits on your own. There's a real risk of holding stocks that become completely worthless. Many stock investors use leverage, which can amplify both gains and losses. SIPs are like a steady ship, offering more protection against these risks. With regulation and diversification, market manipulation risk is very low. Fund managers handle all corporate actions, keeping it simple for you. Diversification makes it unlikely you'll ever hold completely worthless funds. SIPs don't use leverage, so you are safe from that added risk. SIPs offer more stability, no need to worry about market manipulation, corporate actions are managed for you, and there's no risky leveraging involved. It's a safer path compared to stocks where risks are often hidden in stocks. In the long run, SIPs offer steady growth and peace of mind. For more insights, check out my book on SIPs in English. It's also available in Tamil for regional readers. Visit my blog for more financial tips and resources. Watch our next previous videos for more on smart investing.